Welcome back to Finance for Firefighters. Today we're going to talk about risk. We all know firefighting is risky, and most firefighters think that by playing it safe, you're avoiding risk by keeping things in savings accounts. But in reality, doing nothing may be the riskiest move of all. By the end of this episode, you'll understand how to manage financial risk the same way that you do fireground risk by using the right tools and taking smart, calculated tactical action. Firefighters face risk every day. We don't avoid it, we expect it, we train for it, and we take smart tactical action to manage it and control it. And financial risk works the same way. You can't eliminate risk, but you can manage it. Inflation is guaranteed risk if you sit on cash. Market volatility is temporary risk that can be managed over time and reduces over time, and it's part of long-term growth. Inaction is still a decision, and it may be the most expensive one. If you buried money in a mattress and threw it in your backyard, inflation is going to eat away at it, just the same way as if you threw a piece of steel out in your backyard and the elements got to it. Slowly and steady over time, that would get degraded and corroded by the elements. Inflation works the same way. The real risk isn't losing money in the market. It's missing the opportunity for growth over time. Here's a 4-step action plan to help you mitigate your risk. Number 1, separate money by purpose. Emergency funds should be safe, liquid, and easily accessible to you. For short-term goals, use things like CDs or T-bills. Long-term goals take on more risk with diversified investments like index funds, ETFs, or blue chip stocks. But the risk is reduced as time goes on. So the longer you hold on to it, the lower your risk drops. Real estate adds diversification, allows you to have appreciation on your properties, but there's a timing element of those. It's definitely much less liquid to you than some of the other accessible funds. Real estate also requires patience, awareness of the market, and then also some necessity for cash flow. Number 2, safe does not mean risk-free. Savings accounts may feel safe, and they do protect you from market drops, but they do not protect you from inflation and the watering down of your money. True safety comes from balance, having enough liquidity and assets to be able to draw from on your necessities, and then having enough of those assets put into things that grow over time so that your wealth is building. There's no way to eliminate all risk, and most people that try by keeping things in savings account end up succumbing to the risk of inflation, which they don't notice as much over slow periods, but as time goes on, they definitely lose more money that way. Number 3, act consistently, don't expect perfection. Automate investment accounts every month. Dollar cost averaging will help you not have to worry about the timings of the ups and downs of the market. Don't worry about timing. Trying to time the market will many times make you miss out on opportunities that you will have had, and then you'll miss out on all of the growth that you will have had over that period of time. Trying to time the market when you're not a professional, and quite frankly, neither am I, is much more difficult than it seems. There are plenty of people with several advanced degrees that aren't even able to do that. So the main point is staying invested beats trying to time the market every time. Number 4, use insurance as your PPE. Life, disability, and umbrella insurance protects your downside. Every firehouse has their coffee table investor, somebody who's become an expert because of just dumb luck. I'm not a professional, and the professionals get it wrong most of the time. So definitely the folks you work with at the firehouse probably aren't as qualified to give you financial advice as you may be yourself by just doing a little research. Before you listen to the coffee table advice and move any money around based on those conversations at the coffee table, pause and ask yourself, what's this person's track record? If this person's talking to you about a canvas opportunity and they're the same person who just pulled $100,000 out of their house to purchase a boat, that may tell you all you need to know. Follow proven systems, don't chase the hype. The best investors are quietly consistent. They're not making rash decisions based on things they hear at the coffee table. Long-term investing doesn't mean high risk. It means staying in things that are reputable and for longer periods of time. So you're really just trying to beat inflation, not trying to win at gambling. Here are some examples of some relatively safe, long-term proven investments. Index funds. Index funds diversify across hundreds or even thousands of different companies and really hedge your bets. Some of them are tied to different indexes like the S&P 500, things like that. Those ones tend to be more safe. They're not going to make you double or triple your money instantaneously, but a lot of them have a 7 to 10% rate of return consistently across the board. Blue chip stocks are large, time-proven companies that at times often dividends based on some of these stocks that you own. Targeted retirement funds automatically adjust the quantities of stocks and bonds, mutual funds inside of them over a period of time. So if you're investing in things like that through your 457 or other retirement accounts, they'll be more risky and more growth focused when you're younger, and then as you age, they will drop off some of those riskier holdings and switch over to more conservative ones so that you have that money when you retire. Municipal and treasury bonds are other ones that have a much less rate of return, but they are really, really safe. Ask yourself this question: which firefighter would you rather be? A firefighter sitting on a pile of cash that's getting watered down over time, or somebody who's taking consistent tactical action and planning for the future based on some of those investments and having different eggs in different baskets? Let's go through some common questions. Is the market risky? Well, of course the market's risky, but short term is way more risky than the long term, right? If you are planning for the long term and you're doing things like index funds or target funds or some of those blue chip stocks that we talked about, those tend to be a lot less risky over the long term. The volatility is going to continue to happen, but if you're planning on having that money in there for an extended period of time, you're not going to have to worry about the timing pieces of it. If it's in there for 5, 10, 15, 20 years, growth will happen no matter what. What if I invested the wrong time? That's why we dollar cost average. Dollar cost averaging means that if you had a lump sum money of say $10,000 or $100,000, you wouldn't take all of that at one time and invest it that same day. Maybe you split it up over 12, 24, 36-month period, and you divide it up by that amount of times, and then you would put in that amount each month or weekly. That's called dollar cost averaging. Can I avoid risk completely? No, you can't. You can understand that inflation is a certainty, it will happen, and you can understand that by having money invested in the market over time, risk is reduced. Risk is part of the job and part of life. The best thing to do is not try to dodge it, but try to manage it. Put your money to work, protect your downside, and let time do the rest. Download the risk management guide in the description below. Thanks for joining me on Finance for Firefighters. Same as always, thumbs up if you like it, comments below. Hope you guys have a good shift. I'll see you in the next one.